Hello and welcome to this week's trading strategy video from me, David Jones, and Trading 212. This week we're going to take a look at the Moving Average Convergence Divergence indicator, so that the MACD indicator. And I thought I'd cover this because based on some of the comments we've had in recent weeks, there's been a lot of requests to look at this in a bit more detail. So I thought that's what we do this time around. In recent weeks, we've looked at a mix of different oscillators. We've looked at trading psychology, trading using price action, common trading mistakes, which was a really popular one. So we'll be doing similar videos along those lines in the next few weeks. But for this week, let's focus on the MACD. Now, I think, as I've said in the past, I'm really not a big fan of having 10 different oscillators on your chart because I think you can end up ignoring just what the price action is doing. So personally, the MACD isn't one that I look at particularly often, but for you, maybe it's different, and maybe it will add something to your trading. So first of all, as usual, let's take a look at the theory behind the MACD and how it's meant to give us signals to buy or sell. Let's start off with our MACD. So we'll start right from the basics and build it up. So typical settings for a MACD, 12, 26, 9. We start off with our zero line here, the middle line on the oscillator. The first line that gets plotted uses the 12, 26. So it's the MACD line. It gets calculated by subtracting the 26-day exponential moving average of the price from the 12-day exponential moving average of the price. So our MACD line might look something like this. So as the market moves around, the MACD line will oscillate with the ups and downs of the market. Then we have a second line that gets plotted. So this is the 9 part of the calculation. So this is a moving average of this line. So it's designed to try and smooth out that line and give us some signals. So let's start drawing that. So the signal line might look something like this. So it's a 9-day moving average of this blue line. So it will lag behind, but trace out, broadly speaking, a similar sort of pattern to that line, and it looks something like this. So it's called the signal line because this is where we get the signals from. So from a very straightforward point of view, a crossover up here would be a sell signal. So when the MACD line falls below that signal line, we get our sell signal, and then an upward cross down here would be a buy signal, and so the whole thing goes on. But then on top of that, we have a thing called the histogram, which I'm not going to do a very good job of drawing, so I'm just going to do a brief example of that. So the histogram shows how close these lines are to crossing over. So down here, when they're quite far apart, it might look like this, and they get closer and closer and closer, and then we get the cross. So some people might use the direction of the histogram as a way of almost second guessing when the signal is going to come. And then finally, above the zero line, when the lines are above the zero line, the market is thought to be in a bullish mode. It's going up, the trend is up. When the lines are below the zero line, the market is thought to be in a bearish mode, the trend is down and the market is sliding. So there's a few different bits there, but as usual, I think this makes a lot more sense when we look at a real example. So there we go, there's the theory behind the MACD. I suppose it's pretty similar to slow stochastics in a way, which is something that we've covered before, this idea of a crossover, the two lines crossing over and generating the buy and sell signals. But as I always say, it's one thing to read it in the textbooks, this is how it should work. In the real world, it can be a little bit different. So I think for our real world example this week, let's take a look at the MACD on a pound US dollar daily chart and see how good or how bad the signals might have been. We'll use pound against the dollar as our real example. We've got this on a daily chart going back to the end of 2016. So each candle represents a day's worth of trading. We don't have any other information on the chart apart from what the price has been doing. So let's add our MACD. If we go to indicators up here, we can click and we can choose, go to oscillators, we can find our MACD in there, or a shortcut. If you go to most popular, because it's one of the most popular ones, you'll see the more popular indicators in there. So let's click on MACD. Here we go. So my setup here has got the default values. So 12, 26, 9. If I click on confirm, the MACD gets added to my chart. So let's just bring this up just so we can see everything a bit more clearly. So let's walk back first of all. Let's just look at some of the straightforward signals. So coming in, or last year, December 2016, sell signal there. So we have the lines crossing over, giving us a sell. We have a buy signal in there, which wasn't that good, it was a bit early. And a buy signal there, which was a lot better. Then we had our sell signal there, which eventually worked out okay. A buy signal down there, you can see the crossover, 14th of March. Sell signal there, not that good. Sell signal up there, it was okay, I suppose, if you were patient and stuck with it. Then a buy signal down here, the 28th of June. And the most recent signal we've had is on the 3rd of August, which were this sort of area up here. That was our sell signal. So the daily MACD didn't do too badly when it comes to pound dollar over the last 8 months or so. And here you can see the histogram, and all the histogram is showing us. You can see here if we look at this period here from March, where the histogram starts to turn green from being red, it means these two lines are starting to move closer together. So it can be an early warning to get ready for a signal. And then when the lines cross, such as here, the histogram moves over that zero line. So it shows us the signal had happened. And the same back here, we only have one day where the histogram had dropped. But again, it suggests that maybe momentum is starting to fade. And then bang, when it slips below, that's our signal that the lines have crossed over. And the last signal we had at the end of last week, that's the end of the second week of August, the market had, the histogram was turning green, suggesting the lines were starting to move a little bit closer together. So that's the MACD histogram on a daily chart for pound against the dollar going back over the last 8 months or so. So there we go. It actually didn't do too badly, despite my cynicism about having lots of different oscillators. I'm still a bigger fan of looking at the price first. I'd say don't let oscillators obscure the fact of what's going on in the market. So if you haven't watched those price action trading strategy videos, make sure you watch those. But for this week, we'll start to wrap things up. As usual, if you'd like anything covered in the future that you think we've missed, leave us a message in the comments below. If you like the video, click the thumbs up, and to make sure that you never miss out, if you subscribe by clicking the button that should have magically appeared here, you'll get notified when the next videos get uploaded. But from me, David Jones, and Trading 212, we'll wrap things up there, and I hope you have a good trading week.